Okay, this week, the topic is discounted cash flow for Tesla. Our guru here, Adam Khoo, he posted this tweet talking about Tesla valuations. Okay, so he said that after dropping more than 50% from high, Tesla now is cheap. Stop guessing, learn to use the intrinsic value calculator. So basically, he take the 2022 and 2023 free cash flow, which is 7.5 billion and 3.7 billion. And then basically he used this free cash flow as a starting point and say that, okay, his assumption is that this free cash flow will grow by 19% for the next 5 years. If you take the 7.5 billions, then you will end up with an intrinsic value of $89. But if you take the 3.7 billion as the starting point and you just apply the similar growth rate of 19% and then just over the next 5 years, you are actually getting an intrinsic value of $47.53. That's actually very, very low as compared to current share price. So I think his point is to say that Tesla, even if you look at the share price, it has dropped by I think about 40% over the past few months, but still it is not cheap. Okay, it is still expensive because the intrinsic value based on his calculations will be between $47 to $89 depending on which free cash flow as a starting point you use as a starting point. Adam is very nice. He has provided some details, not just like throwing numbers out and let you guess like how he arrived at the numbers. So basically, this is his data source. Okay, this is coming from Yahoo Finance. You can see that 2022, that's where he get the 7.5 billion free cash flow. And then he also shared the screenshot of his intrinsic value calculators. So I think with all these details here, actually we can replicate the calculation and understand what he's trying to do here. So I'll just highlight like there are few key inputs coming from these intrinsic value calculations. The first one, of course, this is a discounted cash flow, meaning that he need to project the free cash flow over the next, in this case, is like over the next 20 years. And then because you actually project based on today free cash flow and then grow into the future, right? So the first starting point, free cash flow, will be one of the most important input. Here, he just put in 7.5 billions. And then, okay, this is the first important key input. The discount rate that he used is 8.1%. And you look at the growth rate, right? Basically, this is not the revenue growth. This is the free cash flow growth. So we need to be very specific on that. And he's assuming the free cash flow will grow at 19% for the next 5 years, followed by 15% for the following 5 years. And thereafter, from year 11 to 20, he just apply like a 4% rate. This is just, grow in line with the GDP numbers. Okay, so these are the key input that's required. Of course, his calculator, there's a bit of other details as well. For example, like how much debt on the balance sheet, how much cash on the balance sheet. He converted all this number to per share basis, and then basically after you do the present value and then the present value of all the free cash flow, and you have to do all this adjustment, and that's how you arrive at the $89.34. That's the intrinsic value. Okay, and if you take this as the so-called the intrinsic value, and then you just compare with today's share price, right, which is last close is 182 based on the time when he did these computations, the company is overvalued by 100%. So meaning that you are paying like double of the intrinsic value. So that's his conclusion. And then if you look at the other scenario, which is that what if we don't take the 2022 free cash flow and we just take the recent 1 year free cash flow, which is 3.7 billions. This is after the price cut. That's why the free cash flow is become a lot lower. Then you end up with like $47, which is even lower. So that's his point, right? So I think for those who follow Adam, you know that he's not a big fan of Tesla because of he has his reason. I think the key one will be that auto business is a low margin, high capex business. So if margin is low, capex is high, free cash flow will not be that high, right? So and it's not high today, and in the future it's unlikely to go high also. So in that case, if you really focus a lot on the financials, Tesla may not be a company that's attractive to you. Okay, so that's his point. I will go into more details just to give you some of the details of the calculations. So like I said, the good thing about all this sharing is that he provided the screenshot. So I can actually start out with all these numbers coming from him, and then just plug into the Excel and just verify, like try to understand it in details, what is he trying to calculate here. Because all these free cash flow, discounted DCF model, all this model, right? Although everyone use the same name in terms of like the valuations, okay? They should just say, okay, DCF, okay? But actually, everyone's models is different, slightly different, like different variations in terms of the complexity, in terms of the input, in terms of how complex or how detailed is your model. That is really up to the individuals to construct your own model. But the only thing that you need to do is that after you project all this, whether it's free cash flow or net income or operating income, you need to discount back. Basically, when you do this discounting approach to value the company, that's the DCF. But the details on how you do the projection, that is really like up to you. Even anyone you're watching this, right? You can also do your own model and just compare your model, your input, your assumptions versus Adam's one, and just compare, right? And see where's the difference. Okay, the calculation wise isn't that difficult. Okay, like I said, the free cash flow first year, you just input the number here. Basically, I just take his number, and then you just apply all this growth rate. Basically, just free cash flow times the growth rate, 1 plus the growth rate, basically. So you can grow it for 20 years. Okay. Then after that, there will be a PV calculations here. So basically, if you use Excel, you can just use net present value NPV, and you just calculate NPV based on this, right? And that's it. Once you get this, you take the debt, you take the cash, and then just apply. You get the intrinsic value. This is the entire company's 282 billion, and then you just divide it by the number of outstanding shares, which is here 3160 million. Okay, then you get the numbers. So I can get to the exact decimal because he provided all his input. So it's not that hard to replicate these calculations. Okay, but I found it quite interesting in terms of like his approach. Okay, because I also have my own free cash flow DCF model. I did similar exercise before, but I don't arrive at this number. But that's where's the difference, right? So that's the things that we want to find out today. Okay, so the first thing I noticed is that when he do the discounting, right? So he just net present value of all these calculations. There's no terminal value in his calculations. Okay, you can argue that because he's already stretched out the projection year to like 20 years. So, I mean, whether you need a terminal value or not is like arguable. You can say maybe it's long enough that you don't need that terminal value. But I think many other models that I've seen, usually people will put in a terminal value and they don't project so long. Usually they are projecting like 5 years, at most it's like 10 years. So after the 10 years, you just assume that there will be a terminal value, which is a on, for example, free cash flow. Okay, so that's how you end with like 10 years, and your projection, you don't have to make opinion on what's going to happen after 10 years. Or you can say that all these expectations, you just like string them to one single input that you need, which is the multiple. Okay, basically you can project like 10 years. And then on the 11 years, let's say the free cash flow is 36 billion. You say, okay, maybe free cash flow at that point is 36, but people are willing to pay, for example, like 20x of free cash flow. Okay, so you take 20 times the 36 billions, you end up with a terminal value. Okay, then you still need to take that terminal value and discount it to today's price. Okay, so that's the step that his approach is slightly different now. Okay. And to make things like more interactive, I would just say here I'm not going to just like put in my own model and then just compare my DCF versus Adam's one. Okay, because my opinion maybe it's not that valuable. Who am I, right? But I think in this case, just for the purpose of comparison, I'll bring in the models from Professor Aswaf Damodaran. So he actually made DCF of his model. And then he actually make a great video in terms of explaining his rationale of how you do his projection. And it's very, very detailed, I would say. Even for the revenue, it's not like just single number. He project a single revenue, right? He actually project different line of business. For example, like their energy business, their service business, and so on. And then he will assign some margin to each line of this business to derive the operating income. And then from there, he also have assumptions of how much capex is required, and then do the capex adjustment, and from there arrive at the numbers, which is the free cash flow numbers. Okay, I won't go into details in terms of his model. I mean, for Professor Damodaran, he even provided the Excel to derive all these calculations, but it's quite complex. I don't expect you to dig into that details lah, but we just need to take what is important from his model, and then we do the comparison here. Okay, I'll put his models, his blog post, and also the link where you can download his Excel in the description, so that you can I mean, for those who are not like you want to look into the details, feel free to do so, right? Okay, this is Professor Damodaran's DCF calculations. Okay, I already extract the important one. All the details, for example, the revenue, the different line of business, that one is outside of today's scope, because I just want to extract like the free cash flow numbers, so that I can compare against Adam's numbers and let you see like why the numbers are so different. Okay, first thing to note is that here I'm not taking in terms of Adam's numbers, right? I'm not taking the free cash flow of 3.6 billion, which is the lower one. I already took the higher one, okay, which is based on 7.5 billion free cash flow as of 2022. Okay, this is starting point, 7.5 billion, and then yet we arrive at the number of $89 of intrinsic value. Okay, but when you look at Professor Damodaran's numbers, right, you can see that his intrinsic value is $180, which is, I think, quite close to today's price at the time of recording. But where's the difference, right? Is that okay? Free cash flow wise, Professor's numbers is a lot higher, so you can compare this number, right? This column here, this is the free cash flow, and then you can compare against this number here. And the interesting thing is that if you look at the the free cash flow numbers, they are not that different. You see, at year, let's say 11, right? Adam's number is 36, Damodaran's number is 44. 36, 44, you want to argue that Damodaran's numbers is a bit higher. I'll say, okay, that's true, but it's not like 2 times higher, right? Okay, so that's one thing to notice. Second thing is that, just like I mentioned about the terminal values, in Professor's numbers, he have this terminal value, okay? And in terms of terminal value, this is not the number. This is just the free cash flow number, and then you use this projected free cash flow number multiplied by a multiple, and you arrive at the terminal values. Okay, so the calculation is here at the bottom here. You can see that the multiple that he used is 25. So in terms of the calculations, he actually end up with like $1.2 trillion after 10 years. So this is the terminal value that he has. And how he calculated this, right, is just that taking the free cash flow and then divided by this 9% minus 5%. So just to give you some background of this number, the 9% is the discount rate, and the 5% is the growth rate, the long-term growth rate. But essentially, this will be the number as if this company free cash flow will continue to grow at 5% every year, but you just need to drag on for hundreds and hundreds of years, and then you discount back at 9%. That's how you arrive at this 1.2 trillion numbers. And this is as of year 10. You still need to discount back for that 10 years to arrive at the present value. And the present value of that terminal value, right, is 471 billion. Okay, this is the number. This is basically this is the value of the free cash flow after the first 10 years. Okay, 471. And the present value of the free cash flow for the first 10 years is this number, 132 billion or 133 billions. So there are 2 parts, right? The first part is the first 10 years. The other part is the after the 10 years, which is like, shrink down to just one figure, which is the terminal value. Okay. And basically, when you want to calculate the discounted, like the intrinsic value, this number, you have to take the present value of the terminal value plus the present value of the free cash flow for the first 10 years. These two need to be added up. So you get this 600 billion. And of course, you still need to do other adjustments. For example, how much debt on the balance sheet, and then how much cash, and so on. So after you do all the adjustment, you end up with 570 billion. and then after you convert to per share basis is $179 per share. Okay, there are some differences in terms of like all this cash number, debt number. I believe this is just like timing difference because I think when Professor did his valuation, it was I think 1 or 2 quarters back. It's not that long ago, but if you take the number, you take the snapshot at different quarters, you will end up with slightly different numbers. But they are not that different. The biggest difference is that the terminal values calculations. Because if you see here, right, if I break up Adam's number, like I just apply, because his calculations is basically just discount the cash flow for that 20 years, right? So I can break down the first part, which is year 1 to year 10, and then the second part, which is year 11 to year 20. If I break out these two, essentially the second half one is the terminal values, right? And then the first part is the same. It's just the present value of the first 10 years. Okay, you look at this present value of the first 10 years. Is 124 coming from Adams versus Prof number is 133. Not that different, okay? It's quite close. But if you look at the terminal values, they are very, very different, okay? One is about 300 billions, the other one is 1.2 trillions. That's 4 times difference. From this number, I can derive to say that, okay, what is the implied multiple that used by Adams, right? It is about 8 years. 8 times. Only 8 times the free cash flow at that point. So he arrived at this number. And after you discount back, of course, here the discount number is different. It's 8.1%. After you do the discounting, it's 135 billions versus 471 billions. That's a huge difference, right? So I would say in terms of the projection, they are not that different, but the difference here is really how you construct your model. In Professor case, he's using a terminal value approach. When it comes to Adam's numbers, he's just like projecting 20 years and discount back, as if you are getting, as if like Tesla is a company that able to project, generate 9 billion free cash flow in year 2, and then 10 billion, 12 billion, 15 billions. After you generate all this free cash flow until the end of the year, then suddenly what happened after that? You don't get anything at all, like zero free cash flow. 0, 0, 0 thereafter. Okay, in that case, you only get your free cash flow as the owner, right? You only get your free cash flow for 20 years, followed by 0 afterwards. Okay, that's basically what is implied from this model here. Let's go into more details to give some nuance in terms of the inputs here and assumptions here, so that we learn a little bit more aside from just comparing the discounted cash flow approach here. Okay, first thing, let's look at the income statement and how does it looks like. Because here, right, when I say all this input, right, for example, free cash flow, how do you arrive at free cash flow, right? You need to understand free cash flow is just not a number that magically pop up, right? This is cash that is generated by the business. And how the business generate all this free cash flow is that first they need to sell the cars and sell other services, and then take in the money. They have a lot of expense. After deduct all this expense, and then you have operating income, and then you still need to grow and need to spend on capex. You still need to minus all this capex to arrive at this number. You cannot just say, oh, all this is like not important. I just want one number, and based on that one number, I conclude that the company is overvalued or undervalued. You need to look at the overall business in more details to have a better appreciation on whether this is a company that's worth investing or not. Okay, so let's get into the financial here. Okay, in terms of the financial, you look at their financial statement, you notice that, auto sales, meaning selling cars, right? Like all these Model 3, Model Y, maybe in the future they have Cybertruck and so on. This is like close to 90% of their total revenue. Okay, they still have other sources of revenue, for example, like regulatory credit, their leasing, the energy business, and their services. These are all contributing some revenue to the company, but as of now, it's still a small percentage. Okay, this number here is the latest quarter. Okay, just one quarter numbers. So let's say if you want to roughly gauge what is the number over the 1 year, you can just multiply by 4. Okay, so this is the number here. And you can see that total revenue for 1 quarter is 25 billion. Okay, so now 1 year, what run rate is about 100 billions. And then gross profit 4.4 billion, operating profit 2 billion. I would say 2 billion operating profit. This will be the most important numbers, because the others, right, for example, like all these tax benefits and so on, all this is just, I mean, it's more towards accounting rather than it's not operating figures. Because for us, we want to know the numbers that is generated by the business, the operation of the business, right? So I would say the operating profit will be a more reliable numbers compared to the rest, which is all sorts of, like accounting adjustment and so on. Okay, so I would say the company is profitable. Okay, 2 billion. This is 1 quarter, so 1 year is about 8 billion. So this give you a good snapshot of the companies. So the next thing I just want to say that when you look at Adam's numbers, right, he has 2 numbers. Because there are 2 different starting free cash flow number, right? The 7.5 billion versus the 3.6 billion, right? Those are very different numbers. It's like 2 times, meaning that you take one or the other, you will end up with discounted cash flow or the intrinsic value that is like 2 times difference, right? So, but why is it the case? It's because if you look at the past free cash flow, you'll notice that this is not a number that is very stable over time. Okay, it just go all over the place. Some quarter is very negative, some quarter is positive. Even when it is positive, it is not like a stable number. It's not like you bought a condo and then you just rent out your condo and the rental that you receive every month is like very stable, right? It's not that like that. This free cash flow number is not stable because in terms of their capex also, it's not like every month spend the same numbers, right? So it fluctuates over time, and when it's low, it could be as low as less than 1 billion in the recent quarters. Okay, when it's high, it can be as high as 3 billion in like one quarter. So it is very volatile. Okay, volatile means that it's very hard to pinpoint a number, say that I can use this number for the DCF and it makes sense. Okay, it's just need to be aware of the input and the characteristic of the input that you are using. Because if you take revenue, at least revenue isn't as volatile as free cash flow. Okay, free cash flow is very volatile. This is all this bar, right, is each of these bar is 1 quarter, and here this number here is still the free cash flow, but it's like a 12 months rolling, meaning that every bar here is the free cash flow of prior 4 quarters. So as you do a 12 months rolling or 4 quarters rolling, right, the numbers will be will looks more stable because of the averaging. But still, you can see that I mean it changed quite a lot, right? In the years where before they become profitable, which is before 2019, right? You can see that the free cash flow numbers are very negative, and then after they become profitable, after they successfully ramp up Model 3, Model Y, you can see that it already increased. Okay, and then after that, recently there's all this price cut and so on. You can see that the free cash flow, of course, they are affected, right? So it came back down here. So you can see this quite clearly. But still, the focus here is to tell you that free cash flow is very volatile and it will change depending on how much capex, depending on their pricing and many other factors. Okay, so this is just take note on this. This is quite interesting. It's why today suddenly talk about Tesla, suddenly Nvidia pop up, right? It's not to say that, okay, just because Nvidia moon, then I need to talk about Nvidia. It's not like that. I just want to take this as one example to illustrate to you, like, if your focus is on free cash flow, and if your focus is on, projecting the free cash flow, right? And what you have is only the past numbers, right? And you try to use the past number and extrapolate to the future, right? It's not that easy, Just want to give you some idea. If you look at Nvidia numbers, I mean, just go back to 9 months early before, right? These are the numbers that you're looking at, right? You're looking at, okay, the good part about Nvidia is that their free cash flow rarely drop to negative. I mean, most in the past 10 years they are mostly green, right? Only like 1 or 2 bars here is negative. But it's profitable, but it's not like super high, right? You can see that the numbers it's about like 1 to 2 billion when it was doing good. That means they are earning like 8 billion of free cash flow per year, right? So this is the number that we are looking at. So if you use this number as your your DCF model, maybe you will pick like the starting point. It could be, let's say, 8 billions, right, as the first starting point, right? Similar to the Tesla situations. and you do your valuations, and then you may think that, okay, based on the free cash flow here, I do my DCF. It's very low compared to today's share price. So of course, Nvidia is overvalued, right? So this may be the case when you look at the numbers just maybe like 6 months or 1 year ago. Okay, so what happened is that, if you look at Nvidia, just in the recent 1 quarter, because of you can call it like AI hype, but when you look at financial number, there's no hype there, right? These are the actual free cash flow that they have been generating over the past like 2 quarters. And just in single quarter now, they generated like 7 billion in 1 quarter. Okay, remember, like if you go back to the previous one, it's that you look at the past number, you are thinking that, okay, maybe they just go up a little bit here. Maybe when they increase their free cash flow, I can see that they can hit 3 billion, 4 billions, maybe they can hit 5 billion, 7 billion, but that could be 3-5 years down the road, right? But you look at just within short period of time, suddenly they generated 7 billion in just 1 quarter, right? And this number is still increasing. So just to give you some like taste that sometimes all this free cash flow, when we look at the past, our brain tend to like trying to extrapolate the numbers. But we always fail in terms of like extrapolating, because all these numbers just change a lot. It can change a lot over a short period of time. So this is basically the takeaway from bringing in Nvidia here. Okay. And of course, if you look at last 12 months basis, right, or rolling 4 quarters, right now it's like 17 billion. But you know that the recent quarter is already 7 billion and it is still growing. And this year, talking about like 2024, right, I'm not surprised that if they are able to generate 40 billions. So if they are able to generate 40 billions, looking at this chart, right, like let's say 1 year from now, you notice that this bar here, like we are stopping at, like 7 billion, right? If it is generating, let's say 35, 40 billions, right, it is like much higher. So you can see like really the financial, the free cash flow went to the moon, right? So just to give you an idea that it's really hard to predict free cash flow. Revenue maybe is easier, but when it comes to free cash flow, because you have the revenue sides, and you have the expenses and capex side, you are looking at the difference, right? The difference between these two figures. So when the base is very small, it is very volatile. Okay. All right, let's come back to Tesla. So for those who are interested, to look into more details, I'll suggest you look at the deck that they send out every quarters. You don't have to look at the 10Q. The 10Q, they have a lot more informations. But at least for investor that's focusing on like fundamentals, I think this deck here have like enough informations for us to process, for us to have an idea like where's their financials heading to. Okay, so there are quite a couple numbers that is interesting here. I'll just point out a few, but later we'll go into more details. Okay, the first one is that, okay, all these, they have the revenue coming from different sources, like the auto and their energy and services. You can see that what's the numbers like, and then you can see the year-over-year growth rate. And you can look at the revenue, the gross profit, the margin, the operating margin. I would say the operating margin here, this will be a very important numbers now, because if you look at the numbers, just 12 months from ago, right, they were generating 16% operating margin, and now suddenly just dropped by half, right, to 8%. Okay, whether the company is able to generate huge free cash flow down the road, it really depends on what is the profit margin. Are they able to increase their prices, or at least like keep the prices and not cutting prices every quarter? So this will be determining factors in terms of are they able to generate free cash flow or not. Of course, the top line is important. The top line here, okay. The margin is also important, and the rest will be like the capex. But capex wise, I think yes, of course, is increasing because they are still building gigafactories. They still have high ambitions. That's why all these capex, they cannot save money on this. They need to spend all these capex, and the companies it's still growing, right? So these are the important numbers here. Next one, let's go into some details in terms of the financial, and then from there we'll get into more details in terms of like the DCF that I want to present to you, which is something that's simpler, but I hope that you will learn something from that. Okay, so first thing I want to mention is that Tesla is still in a growth phase. Okay, if you look at the bar chart now, this is the revenue I mean, congrats to those Tesla shareholders who got in when they are generating less than 5 billion revenue per year, right? So this is the period where they only have Model S, they don't even have Model 3, right? So this is before they scale up their business, and you can see that the growth in 2022, 2023, all these numbers looks just fantastic, but they are not stopping there, right? Currently, it's earning about 100 billions per year, but this number is still will continue to go up. Okay, this is the looking at their growth. Then secondly, let's look at the margin, and here I think I just take the EBITDA margin just to give you some idea, okay, in terms of whether they are profitable or not. Okay, during the period after COVID, right, their numbers are fantastic. You know, they are increasing their revenue, at the same time they're increasing their profit margin. And why they can do that is also because they are still able to, you know, source the material, source the input, whereas other companies, they have a supply chain problem. Some companies, if you still remember, they have to stop their productions because they can't get certain parts, right? But for Tesla, they navigated that very well, and they really, you know, profit a lot because even the resale car price, especially in US, right, was quite high, just like, you know, 2 years ago, okay, one or 2 years ago. And after that, since they sort out all these supply chain problem, if you just track the resale car prices, right, it's actually trending down, and this is across the board, right, including Tesla resale car price as well. So also drop. So in terms of new car, I think you all who pay attention to the news, you know that Tesla just recently, they're still cutting prices. So all these price cut, right, actually hurt their margin. Okay, so just be frank about it. You can see this in the financials. Going down is going down, and it already happened for 1 year already. Okay, and still continuing, because whatever price cut that they just announced like 2 weeks ago, right, it will affect the financial over the next coming quarters. So just pay attention to this. Similar thing, if you look at gross margin wise, up and down, but still, if you look at the recent trend, it's like going down. Okay, so this is the gross margin as of now. The next thing is that we want to say, okay, talking about the growth, previously was quite a high growth, and if you read the transcript over the recent quarters, you notice that there's this how to say, like worries or concern on whether they are able to grow over the next 1 or 2 quarters or not, because indeed the growth prospect over the short term, right, say over the next few quarters, right, is likely to be negative, likely to be not as good as the prior quarters. But if we zoom out a little bit, we don't care, like in terms of like long-term investing, you don't want to like just predicting what's going to happen over the next 1 quarter, 2 quarters, right? We want to look like further ahead, like 3 years, 5 years, 7 years. If we zoom out, right, you can just go back to some of the things that Elon has shared, right, which is they plan to target like 20 millions of vehicles in 2030. And right now, today, like in 2023, they have delivered 1.8 millions. So from 1.8 millions to 20 millions is still like 5x, right? So their ambitions, they really have high ambitions. But of course, we cannot say that, oh, because he target 20 million, then he will hit 20 millions. I'm not saying that. I'm just saying that at least that's the ambition. And from the ambitions, you can, you know, like put in your own inputs, or your own thinking, like how much they can grow to in terms of their production and delivery numbers. So, okay, with all this, right, like margin, with all this, you know, like long-term growth target, we need to synthesize this and coming back to the DCF again, right? Basically, this is my approach, which is I think a simpler approach, but I think just to, hopefully this can give you a little bit of ideas in terms of like how should we value the companies. Because to me, right, whether you do a 10-year, 20-year DCF or 15-year, whether you use a 19% growth rate or you use like 15%, I mean, you can just put in any number that you like and come up with a valuation that is like either super low or super high. And then for those bull and bear, you can just, you know, like put in your own assumption and then produce an intrinsic value and go and make a story out of it to say that, to justify, the intrinsic value is low, the company is still overvalued. I mean, those are the narrative, the story part, right? But I would say that the most important valuation input that you want to put in, right, is number one, what is their growth, okay? And in terms of growth, is like what kind of numbers that you think they can hit by, like, let's say 2030, okay, which is like 7 years from now. Okay, this is number one, the growth. Okay, the second one is that when they are growing, right, are they able to generate nice profit, like decent profit margin coming from the business? Because you can grow like selling 100 million, maybe not 100 millions, that's a bit exaggerated. Maybe like 20, 30 millions car per year. Okay, but if you sell it at a loss, right? So I mean, what's the value of this business, right? They will go bankrupt. Okay, the more car you sell, the more money you lose. Of course, it's not sustainable, right? So the margin is also very important. It's only these two numbers that is very important. The rest are just details. Okay, so my approach here, just to run through with you the numbers, just to make sure that you understand what I'm trying to do here. This row, I'm putting in the numbers as of 2023. They deliver 1.8 million cars, and then generated like 97 millions of revenue. And then their profit margin as of now, right, based on the past 4 quarters, the operating margin is 9.2%. And from the 9.2%, I can get the operating operating income of about 9 billion per year. This will be my starting point. So I'm not going to complicate with all the capex number, deduct all those. I know that for free cash flow, if you use free cash flow, it's very specific. You need to deduct all the capex to derive the free cash flow. But here, I'm just going to take these operating income numbers as my starting point to say that whatever multiple that we're going to use, we'll just do a comparison versus the operating income here, just to keep it simple. Okay. Given today's price of $183, and then that's equivalent to 574 billions of the market cap. And then if you just compare the market cap versus the 9 billions, right? The current multiple over the operating income is about 65 times. Okay, 65 times. You ask me whether it is high or low. To me, still come back to whether how much growth. If it is 0% growth, of course this is expensive. Because if it is zero growth, I would want to pay just, like 8 or 10 times of the operating income. But if the growth is high, of course we are willing to pay more, higher, right? But how much higher, or whether the multiple, whether it's 30, 50, 80, how much you are willing to pay, you still need to fall back to how much growth that you are expecting, right? Yeah. So basically, just take this in mind first, okay? Then in terms of the 2030, the target, right? I just put 20 million. This is Elon's target. Okay, then I have 2 more rows here just to show that, okay, what if they don't hit 20 millions in 2030? What if they just hit half of that? Okay, so about 10 million. And what if they only hit 1/4 of the target, which is 5 million? And these numbers compared to 1.8 millions, this is the implied annual growth rate. Okay, when they say 20 millions means that every year they have to grow at 40%. Okay, when they say that when I say they only hit a quarter, meaning that as long as over the next 7 years they're able to grow 16%, yes, from 1.8 they were able to hit 5 millions. So this is the growth. And then from the growth, we can generate how much, we can project the revenue numbers. Okay, and then from the revenue numbers, I can just multiply by the margin that I assume, and then derive what is the operating income based on different, the target that they hit, the numbers that they hit, whether they are producing 10 million or 20 millions. Okay, so the starting point, I just use 9.2%. Of course, there are people who say that, okay, because of all this software business, because of other, like services, which is of higher margin, and of course, as long as they don't need to keep on cutting prices and able to, use scale to further decrease their expenses or their cost of goods sold, right? They're still able to squeeze more margin from the business, right? So here I just put like 9.2, 12.2, 15.2, just to let you see that what will be the numbers like if they're able to improve their margin. Of course, you may say that this 9.2 is too high, it will continue to go down, you want to put 5%. I mean, you just do the adjustment accordingly, okay? So this will be the operating numbers here. Then from here, how to derive from operating income here, how to derive the market cap, is just that you just put a multiple, right? By the time that 2030, I believe that the company is already not at a super high growth phase. It will already like matured. So I don't think it makes sense to still assume that they are going to grow like crazy and apply like a 65 times multiple, right? So here I just put like a 20 times as a exit multiple or terminal multiple, right? So just take the 20x times whatever operating income here, then I can see that, okay, this is the numbers, okay? So in other words, right, just to give you an example, let's say you don't think they are able to generate like a very high number, like 20 million. Far from that. Let's say we just take 5 millions, right? And you believe that their margin will just be, like just stay at about 9%. Okay. So what it means is that they will likely be generating about 25 billion operating income, and multiply by 20, that's about 500 billion market cap, right? So given that today's market cap is 574, if you hold these companies for like 7 years, and they are just generating like this kind of growth and this kind of margin, no improvement, basically you just earn nothing, or maybe like like lose 2% per year for the next 7 years. So basically that's how I see it. And if you think that, okay, no, actually I believe that they are able to grow. They are able to grow to 10 millions car a year, and then they are able to grow their margin, just squeeze out a little bit, 3 more percent, because of all this scale and all these, like services, FSD working out, they are able to license out, get some good profit from there. Then just you can end up with like 65 billion of, like operating income. And from there, just assume 20x, you will get like 1.3 trillion, okay? 1.3 trillion market cap of valuations, and you just work backward from 1.3, right, versus today market cap, that's equivalent to like 12% return for the next 7 years. And of course you can just continue with that, right, like 20 millions car, and then can go up to like, let's say 15% margin. Basically the company will be worth like 3 trillion 7 years from now, and then that's like 30% of profit every year for the next 7 years. Okay, so basically, of course, there's no end to it. You can put in like whatever margin, 20%, 50%, I don't know, like people can make up like hyperbull story, or they can make up like, Tesla is a scam story, basically by just massaging all this input. I mean, those are, beside the picture. But here, in my opinion, the truth is somewhere between all this number here. It will be around here. You see, to me, it will be between like around about here, 5 millions to 10 millions. But margin wise, I don't think I don't think they can go up like 15-20%, because whatever high margin that we have seen in the past, that was because a very specific episode where other cars, other automakers are not able to produce, and then the resale car prices are so high, and they really took advantage on that. So to me, the high margin in the past, right, will more likely be temporary. And unless really FSD is like super successful, of course they can go up to like 15% or even more. But given FSD progress, let's say if they just do incremental improvement over the next 5-7 years, and I'm not like putting in that into this number here, if that's the case, right, I think that the truth will be somewhere around here, right, these figures here. So that's at least my view when it comes to my analysis. Okay, so all right, I think that's it of today's sharing. Let me just I saw that there's a couple of comment here. For those who have any questions, feel free just to type it up in the comment sections, and then I'll just go through that. And if not, we'll just end the videos. Okay. So Kelvin from Costa Rica. So what's the time at Costa Rica now? Is it like midnight there? Welcome to the live streaming here. Jay, morning, good morning. From Mark also, good morning. Then from Snowball Wisdom, a company with high growth and matured companies should have different multiples. Most I see give multiple of 20 to 30 times free cash flow at year 10, which seems aggressive. Yeah, I do agree. It really depends on what is the growth rate by the time, like your, let's say your projection is only until, let's say, 10 years, right? You need to see like at that point, what kind of the future growth rate that they are able to get. Then to answer that question, you also need to you also need to see what is the total addressable market, right? Because let's say if you just imagine Tesla as a car companies, right? Yes, they are able to generate, let's say, like 5-10 millions, because today Toyota is, I think they produce about like 10 millions car per year, right? So I can see that they are able to generate like 10 million, maybe even 15 millions. To me, that is like within like something that is not easy to achieve, but is achievable. But let's say if you go and project like, let's say 100 millions car a year, and then 200 millions car per year, that's like crazy, right? Because even today, the total productions of all the all the car companies is like, I don't know, maybe like 100 millions, right? So you cannot project Tesla to own more than 100% of the entire car markets. Okay, so that's one thing to pay attention to. And second thing, sometimes when we look at the companies, we think that okay, this company is a car company, and then we just do a projection based on this like car business. But you need to remember, when we project like 5 years, 7 years, 10 years down the road, right? All these companies, they are not sitting idle. It's not like Tesla only got the license to sell car, they cannot do other business, right? So they can do other business. If they do other business, of course they can like keep on increasing their total addressable market, and hence the market can be big, right? Say for example, when it comes to robotic, of course they can do a lot more there. So if they do a lot more and increase their total addressable market, of course they can still sustain a high growth rate, and then from there can justify like a 20 or 30 times multiple. So it really depends. But of course, general rule is that as a small company, say for example, your company only generate like 1 billion revenue per year, it's easier to grow grow a lot when you are that small. And it's a lot harder to grow when you are already generating hundreds billions of revenue, right? So that one is also true. So I think that's also something to be mindful of now. Okay, thanks Snowball Wisdom for the questions. And then next one, got to go. Thanks for putting great efforts for data back session. We'll watch replay later. Good day ahead from Direct MY. Okay, thanks for watching. And then from Kelvin Young. Hello, Kelvin. The world has about 85 to 90 millions new cars a year, for your informations. Yeah, I think thanks for the data. So yeah, I remember the numbers is about ballpark 100 millions, but you also need to remember that's today's number. When you project 7 years, 10 years down the road, who says the car business will be stagnant, right? Because even in like big cities, you can say that big cities you can't support that many cars, very congested. For big cities, maybe tunnel is a way to get across that. Like if you have more tunnels, you can solve the traffic problems. And the other thing is that actually especially like countries like China, US, Australia, these are the countries that they still have vast area of land, right? So actually there's still plenty of space for people to build city, to build road. As long as population is increasing, I don't think that the car market is something that like capped at 100 millions and not increasing, right? It can still increase. So that's my thinking when it comes to this now. Of course, there's many factors because like you need to study some macro as well, like population, like cities plannings and so on. Because in my opinion, whether the car is the most efficient way of transportation, I don't think so. I think countries like Singapore, where the public transport is so good, more and more people taking like MRT, buses. I think that's still a more sustainable way of like transportations, rather than everyone should own their own car, right? So that's my personal view. Okay, I will keep the presentation rather short. Hope that you enjoyed today's session. For this episode, I will try slightly different things because this is a live session. I will leave the live. Maybe I might turn it become unlisted, and I will download the video and then I'll post it as a normal video in my channel. So okay, that one just FYI. So thank you for watching. For those who tune in live, thank you so much. Let's keep in touch. Bye bye.